In the world of investing, growth stocks often steal the spotlight. They're the flashy newcomers promising rapid expansion and soaring profits. Value stocks, on the other hand, are seen as the steady but unexciting players. This contrast sets the stage for the intriguing success of Warren Buffett. Widely regarded as one of the greatest investors, Buffett has built his fortune primarily through value investing. His firm, Berkshire Hathaway, boasts a portfolio dominated by well-established, often undervalued companies. Born in Omaha, Nebraska, Warren Buffett's journey is a tale of financial acumen and discipline. From a young age, he displayed an extraordinary aptitude for business and investing. Buffett's investment philosophy, rooted in Benjamin Graham's teachings, centers around identifying undervalued companies with strong fundamentals. This approach, known as value investing, emphasizes patience and a long-term perspective. His investment journey began in earnest with the founding of Buffett Partnership Limited in 1956. In 1965, Buffett took control of Berkshire Hathaway, transforming it into a holding company. This marked a pivotal moment, setting the stage for one of the most successful investment empires in history. Central to Warren Buffett's investment philosophy is the concept of the moat. In business, a moat represents a company's durable competitive advantage. Buffett seeks companies with wide and deep moats, those with sustainable advantages that are difficult for rivals to overcome. This focus on businesses with moats highlights Buffett's emphasis on quality over mere cheapness. Investing in companies with moats aligns perfectly with Buffett's long-term investment horizon. By focusing on companies with moats, Buffett ensures his investments can withstand inevitable challenges. One of the most illustrative examples of Buffett's moat-focused approach is his investment in Coca-Cola. Coca-Cola's moat is built on brand recognition, global distribution, and a simple yet powerful product. The Coca-Cola brand is instantly recognizable across the globe. This brand recognition translates into pricing power, allowing Coca-Cola to command a premium for its products. Beyond its brand, Coca-Cola benefits from an unparalleled distribution network. This consistency has created a powerful and enduring moat that has protected Coca-Cola's profitability for generations. Beyond the fizz-identifying moats in a changing world, moats can manifest in various forms depending on the industry and competitive dynamics. In technology, a moat might be built on network effects, where the value of a product increases as more users join. In other industries, a moat might be built on proprietary technology, patents, or regulatory approvals. The key takeaway is identifying companies with durable competitive advantages that can protect their profitability. This relentless focus on quality and sustainability sets Buffett's approach apart. The long game, time as Buffett's greatest ally. Warren Buffett views investing as a long-term endeavor, a marathon rather than a sprint. Unlike those seeking quick profits, Buffett lets his investments mature over years, even decades. This long-term perspective sets him apart from the frenetic pace of the stock market. While short-term investors panic during market downturns, Buffett sees these as buying opportunities. His long-term horizon provides him with the conviction to hold on to his investments. This patient approach allows him to capitalize on opportunities that others might miss. Compounding, the snowball effect of long-term growth. At the heart of Buffett's long-term approach lies the concept of compounding. Compounding is the snowball effect of earning returns on your returns, allowing your wealth to grow exponentially. The longer your money is invested, the more powerful this effect becomes. Imagine rolling a snowball down a hill. It starts small but grows larger as it rolls. Each year your returns generate new earnings, creating a virtuous cycle of growth. Buffett emphasizes the importance of starting early and staying invested for the long haul. His early investments have grown exponentially, turning him into one of the wealthiest individuals in the world. Patience versus impatience, a tale of two investors. Consider a hypothetical scenario. Two investors, both with an initial investment of $10,000. Investor A chases after the latest hot stocks, jumping in and out of investments frequently. Investor B, inspired by Buffett, focuses on quality companies with moats, investing for the long haul. Over the short term, Investor A might see some impressive gains, but this approach comes with significant risks. Frequent trading incurs transaction costs and often leads to impulsive decisions. Investor B, on the other hand, patiently holds on to their investments, allowing their portfolio to grow steadily over time. This scenario highlights a fundamental truth. Patience, coupled with a long-term perspective, allows investors to harness the power of compounding to build lasting wealth. The art of stock picking. Buffett's quest for value and quality. Warren Buffett's success isn't just about identifying companies with moats and holding them for the long term. It's also about his meticulous approach to stock picking, balancing undervalued companies with underlying quality. Buffett dives deep into a company's financials, looking for strong earnings growth, low debt levels, and high returns on equity. He also assesses qualitative aspects like management, competitive landscape, and long-term prospects. This meticulous approach ensures Buffett acquires stakes in high-quality businesses with the potential to compound their value over time. Sidestepping value traps, avoiding the allure of cheap but flawed businesses. One of the biggest pitfalls for value investors is buying companies simply because they look cheap. These so-called value traps often reflect underlying problems that can lead to further declines. Buffett avoids businesses with declining revenues, shrinking margins, or heavy debt burdens. Instead, he seeks out companies facing temporary headwinds or market misperceptions. This ability to differentiate between true value and deceptive cheapness is crucial to Buffett's success. Risk. The silent threat to compounding and Buffett's approach to mitigation. While compounding is a powerful force for wealth creation, it can also work against investors if not managed carefully. Losses can quickly erode gains, setting back the compounding process. Buffett places a strong emphasis on risk management, viewing it as integral to his strategy. He mitigates risk by investing in companies with strong balance sheets, predictable earnings, and durable competitive advantages. This diversified approach helps to spread risk and ensure that his portfolio is not overly exposed to any one particular company or industry. The taxman cometh how Buffett minimizes Uncle Sam's bite. Warren Buffett's strategy includes tax efficiency, understanding that taxes can erode investment returns. By holding investments for years, he defers capital gains taxes, allowing his capital to compound tax-free. Investors who frequently trade incur short-term capital gains taxes, creating a drag on returns. Buffett also strategically structures his investments to minimize taxes, often preferring dividends over share buybacks. This tax-efficient approach significantly amplifies his returns over time. Section 2. The power of dividends. Reinvesting for exponential growth. Dividends, often overlooked in the pursuit of high-flying growth stocks, play a crucial role in Warren Buffett's investment strategy. He views dividends as a steady stream of income generated by his investments, providing a tangible measure of a company's profitability and its commitment to rewarding shareholders. But Buffett doesn't simply pocket these dividends as passive income. Instead, he often reinvests them, using those payouts to purchase additional shares of the companies paying them. This reinvestment strategy, known as dividend reinvestment, creates a powerful compounding effect. As dividends are reinvested, they purchase more shares, which in turn generate more dividends. This virtuous cycle of reinvestment and compounding can significantly accelerate wealth accumulation over time, turning even modest dividend payments into substantial sources of income. Buffett's focus on dividend-paying companies also reflects his preference for businesses with strong cash flows and a proven track record of profitability. Companies that consistently pay dividends are often well-established, financially sound, and capable of generating the cash flow needed to sustain those payouts over the long term. Section 3. Tax efficiency and dividends, a powerful combination for long-term success. The true brilliance of Warren Buffett's approach lies in the synergy between his tax efficiency and his focus on dividends. These two elements, working in tandem, create a powerful engine for long-term wealth creation, allowing him to outperform the market while minimizing his tax liability. His long-term holding strategy minimizes capital gains taxes, allowing his investments to compound tax-free for extended periods. This tax deferral supercharges the compounding effect, enabling his wealth to grow at an accelerated pace. Simultaneously, his focus on dividend-paying companies provides him with a steady stream of income that he can reinvest to purchase additional shares. This dividend reinvestment further amplifies the power of compounding, creating a snowball effect that accelerates his wealth accumulation over time. This powerful combination of tax efficiency and dividend reinvestment is a testament to Buffett's deep understanding of the principles of compounding and his ability to leverage those principles to his advantage. It's a reminder that investing is not just about picking stocks, it's about creating a system that maximizes returns while minimizing the drag of taxes and maximizing the benefits of compounding. The evolution of a master investor, adapting to a changing landscape. While Warren Buffett is renowned for his steadfast adherence to value investing principles, his journey as an investor hasn't been static. He understands that the business world is in a constant state of flux. and his investment approach has evolved to adapt to these changing dynamics, demonstrating a remarkable ability to learn and refine his strategies over time. In his early years, Buffett focused primarily on what he termed cigar butt investments, deeply undervalued companies trading for less than their net asset value. These were often struggling businesses with limited growth prospects but offered the potential for quick profits by unlocking their hidden value. As he gained experience and his capital base grew, Buffett shifted his focus towards acquiring stakes in high-quality businesses with enduring competitive advantages. This marked a pivotal evolution in his investment philosophy, emphasizing the importance of not just buying cheap but buying into exceptional companies capable of compounding value over the long haul. This evolution is perhaps most evident in his embrace of technology stocks, a sector he largely avoided in his early career. His investment in Apple, now one of Berkshire Hathaway's largest holdings, demonstrates his willingness to adapt to new industries and business models when he sees the hallmarks of a durable competitive advantage. Crisis as opportunity. Buffett's savvy deals during the 2008 financial meltdown. The 2008 financial crisis, a period of unprecedented market turmoil and economic uncertainty, tested the mettle of even the most seasoned investors. While many panicked, selling their holdings and retreating to the sidelines, Warren Buffett saw opportunity amidst the chaos. Armed with a war chest of cash and an unflappable belief in his investment principles, Buffett stepped in as a lender of last resort, providing capital to struggling companies at a time when traditional sources of financing had dried up. This not only demonstrated his contrarian approach, but also highlighted his ability to strike advantageous deals during times of market distress. One of his most notable deals during this period was his investment in Goldman Sachs, a financial institution teetering on the brink of collapse. Buffett provided a $5 billion lifeline in the form of preferred shares, a move that not only stabilized the company but also earned Berkshire Hathaway a handsome profit. These crisis-era investments underscore a crucial aspect of Buffett's success: his ability to remain calm and rational during periods of market volatility. While others were paralyzed by fear, he saw opportunities to deploy capital at attractive valuations, securing favorable terms that would generate substantial returns for Berkshire Hathaway in the years to come. The Oracle's imperfect vision, missed opportunities, and lessons learned. Despite his legendary status and remarkable track record, Warren Buffett is not infallible. Like any investor, he has made his share of mistakes, missing out on opportunities that, in retrospect, seem obvious. However, what sets him apart is his willingness to acknowledge these missteps and extract valuable lessons from them. One of his most frequently cited regrets is his decision to not invest in Google early on. Despite recognizing the company's potential, he hesitated, citing concerns about its valuation and his lack of familiarity with its business model. This missed opportunity highlights the importance of adaptability and the need to challenge one's own assumptions in a rapidly evolving business landscape. Another notable misstep was his investment in Tesco, a British supermarket chain. Buffett had initially acquired a stake in the company, believing it to be undervalued. However, accounting irregularities and a decline in the company's performance led to significant losses for Berkshire Hathaway, prompting Buffett to admit his misjudgment. These examples serve as a reminder that even the most successful investors are not immune to errors. The key takeaway is that it's not about avoiding mistakes altogether, but about learning from them, adapting one's approach, and continuing to evolve as an investor. Buffett's willingness to confront his own fallibility is a testament to his intellectual honesty and his commitment to continuous improvement. The enduring legacy of the Oracle of Omaha. Warren Buffett's investment journey, spanning decades of remarkable success, offers profound lessons for both seasoned investors and those just embarking on their financial journeys. His story is a testament to the enduring power of value investing, patience, and an unwavering focus on quality and long-term growth. While market trends may ebb and flow, his core principles remain timeless. Buffett's ability to consistently outperform the market, even amidst changing economic landscapes and technological advancements, underscores the importance of a disciplined approach grounded in fundamental analysis and a deep understanding of business. His focus on moats, those durable competitive advantages that protect businesses from rivals, highlights the importance of investing in companies with enduring strengths. His patient approach, allowing his investments to compound over years, even decades, stands as a powerful reminder that true wealth creation is a marathon, not a sprint. His emphasis on minimizing taxes and reinvesting dividends further amplifies the snowball effect of compounding, demonstrating how seemingly small advantages can lead to significant long-term gains. Perhaps the most inspiring aspect of Buffett's legacy is his unwavering belief in the power of learning and adaptation. His willingness to evolve his strategies, embrace new industries, and acknowledge his own missteps reflects an intellectual humility and a commitment to continuous improvement that have served him well throughout his illustrious career. His story is a beacon, guiding investors to navigate the complexities of the market with wisdom, discipline, and a long-term vision.